So today we're going to talk about how dividends work in a whole life insurance policy. We are going to talk about this because yesterday evening, a long-term client, someone I've worked with now for almost 10 years, asked, how does my dividend really work, Steve? Because on my annual statement, the literature she received from the insurance company her policy is with, it says that her dividend bought her more life insurance. And she got her life insurance policy because she wanted to maximize the cash value. So naturally, she wants her dividends to continue to build cash value and not just get her life insurance, which is exactly what is happening. It can just be confusing sometimes, or a lot of times when you have a whole life insurance policy, because the terms are not straightforward, in my opinion. So here's how it works for her. She's had a policy for years now. She's got a lot of cash value in there, but she gets a dividend of, call it $5,000. That's not the actual dividend she got, but we're going to make this example simple. So on her statement, she gets a dividend for $5,000. The statement says, congratulations, this $5,000 dividend purchases you another $15,000 in life insurance. She goes, oh, I want it to go to cash value. What's going on here? So it does. So dividends, what the insurance company will say is that they purchase paid up additional life insurance, which the abbreviated term for that, they purchase PUAs. Now you might know that term because with a life insurance policy, you can elect to add money to your PUA rider, which maximizes your cash value. But here's how it works. So the dividend terminology here is when you receive a dividend, it purchases you paid up additional life insurance. So the dividend of $5,000 does go into cash value. So she will see her cash value increase by $5,000 when she gets that dividend. That will happen, and that's exactly what she saw. Okay, that's great. Why can't they just say the dividend of $5,000 is reinvested in my cash value? That would make life so much easier. Well, I don't have the answer for that. Some insurance companies do include that in their literature, that dividends are reinvested in cash value and also purchase you more life insurance. I've seen Guardian have literature like that, but not all companies do. But here's how it works. The dividend is reinvested into cash value, and it also purchases you additional life insurance. We'll call it here additional death benefit. This will depend on your age, but on average, it might be 3 times the dividend. So her death benefit increases by $15,000. So if before she received this dividend, if she had a policy or her policy had a cash value of $200,000 and a death benefit, money that's paid out when she dies, of $1 million, here's what would work, or here's what would happen. She gets that dividend of $5,000. Now, her cash value is worth $205,000. Her death benefit is now worth $1,015,000. So as dividends are paid to your policy, it's going to grow the cash value and your death benefit. Now, the net growth on a life insurance policy is going to be higher than what you see in this example, because the last piece of this that can be so confusing to so many people, even a lot of my peers in the industry, is when she gets her statement, it says, here's your dividend of $5,000. Okay, great. the company's dividend rate is just about 6%. Does that mean that that 5% represents the company's dividend rate? No, it does not. So her guaranteed interest rate with her product is 4%. It's an older whole life insurance product. Guaranteed rate of 4%. The total dividend rate with that company is just under 6%. Let's make it simple and say it's 6%. So what that means is the company had a surplus rate of 2%. They had their total dividend rate. They had their minimum guaranteed floor that never changes for her. And then the difference between what they make public, you can Google search what's their dividend rate. We see it's 6%. The difference between that and the guaranteed rate is your surplus rate. And the surplus rate represents the dividend that you see on your annual statement. I know it's extremely confusing. I'm not a fan of it because when I see a dividend rate from an insurance company, I naturally think that the dividend, when I see the word dividend on my annual statement, that represents the dividend rate. It does not, unfortunately. So anyway, my point is the cash value grew by more than what we saw here. I just used this example to demonstrate how the dividend works with her whole life insurance policy. And when you are tracking the cash value growth of your policy, especially if you've had it for more than 2 or 3 years, you're going to see that the actual cash value growth, the total dollar amount you got from the insurance company, is going to be more than what they told you you received in dividends, which is a good thing. So usually it results in someone saying, hey, why did I only get $5,000 in earnings this year? It's like, oh, you actually got more. You got about $12,000. However, the insurance company did not tell you that. We actually calculated that for you by looking at what your cash value was last year, what it is this year, backing out your payment. So we typically put that in Excel or try to make it simple for someone. Anyway, I hope that this video was helpful. Let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much for watching. I appreciate it.